says that you have to you can't file the tax return if you don't have 8609s. So we're in this bit of a conundrum. But the audit technique guide and a chief counsel advice memorandum continues on and says, however, if it can be established that filing tax returns without 8609s was due to reasonable cause and not willful neglect, that the credit should not be disallowed. And it continues on and says, if during IRS audit, if this is discovered, there's no prohibition against satisfying these first-year elections, so filing the 8609s during that IRS audit. And so that kind of gets us a little more comfortable where we say, okay, we don't have 8609s, but we know two things. Number one, if we can substantiate that was reasonable cause, the IRS has said they shouldn't disallow the credits. And two, if we can't substantiate reasonable cause, that if we have those 8609s by the time that we're audited, that we can satisfy the requirement at that point. So now what we've seen is this pendulum shifted from saying, hey, let's just wait and amend because there is a little bit of risk here and there's no downside to amending. It swung the other way to say, there's this huge downside for doing an AAR now because it pushes our returns out. So now it's worth taking this quote unquote risk that the IRS may audit us and disallow credits if we can't substantiate reasonable cause or get the 8609s in time for that IRS audit. So what we see happening now is, although we are still pushing our friends at the commission, and so that's Washington State and at Oregon Housing and Alaska and Idaho, all of our friends on the call today, we are still pushing our agencies to say, please give us those as soon as possible. That most partnerships and most investors have gotten comfortable filing the tax return without 8609s, but still we're going to wait till that last minute to see if we get those. But of course, we have to understand the risk there that may be disallowed. So let's pause for a second and say, well, okay, that all makes sense, I hope. And you can chime in if that doesn't make sense. But a couple things. Number one is, what is reasonable cause? Unfortunately, the IRS doesn't give us any guidance on what reasonable cause is. But most people say, hey, if I've submitted my package to the state agency, it's outside of my hands. So I have reasonable cause to file without this because I've done everything in my power to try and get these 8609s. So most people say that's a pretty bright line test and we're comfortable with that. And I think that my clients up here in Washington State, I don't know the other allocated agencies as well. I mean, I guess I know Alaska pretty well. They seem to be very easy to work with as well. And Oregon, in my experience, is pretty good too. Sorry, Idaho, I don't know you as well. Not saying anything bad about you. But I'd imagine that in this state, if you got an IRS audit, that the commission would help streamline your review and get you those 8609s as quick as possible. So it kind of gives us comfort in the fact to say, well, we have reasonable cause and we're likely that the state agency will work with us to get us those 8609s should we be audited. If you're in some other states who will not be named, who are not in the Northwest, I might have a different answer because I'm not sure they would really jump out and help you that quickly. Yeah, so that's kind of where we're at on this. Of course, we'd much rather file with the 8609s than without. So we still want the commission to respond to this and give us the 8609s. So if you have additional questions, let me know. I'm happy to kind of talk about your facts and circumstances. Oh, one other thing on reasonable cause, it gets a little more interesting when we have a project that is a long-term new construction or a long lead time ACC rehab where we were planning on taking credits in 18, 19, and maybe even 20, and we're not able to do that cost cert till that final building's in service. So we're not even starting the cost cert till 2 years after we claim credits on that first building. And so that's when we start to have a bigger question, do we have a reasonable cause in that case? And realistically, you really want to talk to your investor and tax practitioner about that to figure out what you want to do in that facts and circumstances. All right, I'm seeing no more chats coming in. Yep, I think I answered the questions that were in here. Yeah, you have 14 days to get them, but most people are agreeing to file without. If you're still waiting on them, definitely start that conversation with your investor today, if not yesterday, to figure out what we're doing. All right, so great. Let's jump into this topic. This topic is a real grab bag kind of items. Lori and I uh, 9, 10 months ago, we kind of sat and said, what should we talk about this year? Let's talk about something different. Um, we had all these great ideas. And I think pandemic kind of changed some of our thoughts, and it kind of tempered down my ambitious level of what we wanted to cover. So I decided to kind of focus in on just a couple things. So we're going to talk first about hybrid projects because we keep hearing about them. So I think it's good to talk about a high level. Why do people even talk about hybrid projects? What are the pros? What are the cons? And what to watch out for on those? Then we're going to talk about opportunity zones. Not a whole lot on those, but there's $11 billion of investments done in opportunity zones, so we should probably know what's happening there and understand where there might be something for us to use. Then we're going to talk about income averaging. Very quickly, again, going to talk a little bit about why that might be important to you guys as in your organizations and some advantages of doing that. And then we have a grab bag at the end about what do we have in the future with the different bills that are in Congress. I'm not sure we're going to get to all of it, especially the end part. That's just kind of on there in case we don't have questions and I get nervous and talk too fast as I'm wont to do. So let's jump in here. And of course, ask your questions as we go if you have them. And hopefully you can see my screen moving. I see a yes nod. Okay, great. So hybrid projects. So first we have this fun little project here, and we see it has 7 buildings, a community room, and some common area. This project costs $40 million to build. And so we say, should we go 9% or 4%? Obviously, there's a lot more to this discussion than just this, but we look here and say, okay, on 4%, we could generate $3.6 million of equity. On 4%, of credits. On 4%, $1.2 million of credits. So we're kind of sitting there saying, 9% seems pretty attractive, but we see that in many states, there's a limit on the amount of credits you can receive on the 9% side. So I just pulled Washington State, 2020's TBD, but I used 2019, and we see, this project can't qualify for $3 million. And so that means we have what we call excess basis here in the sense that we're doing a $40 million project, but we can only receive $2 million of credits. And so we say, well, is there a way that we can kind of take advantage of this quote unquote excess basis and be able to split this project into two and take advantage of all the basis generated on this project to maximize our equity? So we see that this is just one example of why you might do it. I just kind of wanted to show you how the numbers might work. So we'd say, okay, we're going to maximize our basis so we don't have any excess basis here. Obviously, it's never going to be that clean of a slice because typically you have to slice it between buildings and other considerations. But for sake of discussion, I pretended that we could slice this right down the middle, which may be true for some of us who are doing single family housing or duplexes and things like that. Anyways, okay, so we have this, we have our qualified basis, and we see that when we do this hybrid project, instead of generating just the $2 million that we're capped at, we generate $2.6 million of credits. So we still don't end up as nice if we could have done just a straight 9% project, but we end up better than we can do a 9% with the limitations from our state QAP. So some other advantages of doing this hybrid project. So again, a hybrid is where we're doing a 9% and a 4% on the same piece of land. Is number one, we can utilize excess basis. And this excess basis factor is different in some states. I hate to admit this, but I do a lot of work in California. And in California, that's why I got this surfer look going. Actually, it's just because I haven't cut my hair since pandemic started. So in California, they always have a lot of excess basis. So that was the big push for it to be used there. But now we're seeing bonds are becoming more competitive. So this allows us to maybe right-size our two different resources, our credits and bonds, and use less bonds on this project because now instead of doing a $40 million bond project, we're doing a $16 million bond project. So instead of needing $20 million plus of bonds, we only need $8.5 million of bonds. So it's better using our bond cap. Some states have incentives for hybrid projects. And the real kind of reason for this is to utilize excess basis, but also maximize the units on the land utilizing the two programs so we can get a project that might otherwise not be feasible as a straight 4%, that we can get it feasible using this hybrid approach. So it's closing that financing gap on 4% only, because we see, jumping back here again, as opposed to our 4% only, we're almost doubling our equity here. So that's why we see this happening, but it's not a simple task. Hybrid projects can be a little bit of a headache. So when we're talking about them, the biggest key on a hybrid project is we need to avoid the basis taint on the 9%. So what do we mean by that? So on a 9% project, if you pay for any cost with tax-exempt bonds, you have two choices. Either you can't use a 9% allocation, you have to use the 4% credit rate, which would be horrible, or two, you have to exclude those costs from eligible basis. Also not a good outcome. So we're trying to do everything we can to avoid tainting that basis by using bonds on the 9% project. But even beyond that, we're trying to avoid the appearance of a taint, because often, even if there isn't a taint, you have investors who are the most conservative people alive, right? They use SPF 250 when they go out in the sun because they don't want any sort of sunburn. So number one, usually when we're doing a hybrid project, we have two separate partnerships. We have your 9% partnership and your 4% partnership. And unfortunately, this somewhat lessens the benefit of a hybrid model, because you want to be able to share this additional equity across both projects to be able to really cross-finance them. But you can't do that when you have separate partnerships. But that's part of the game, is we got to avoid this taint, so we end up with separate partnerships. Number two is typically you want to have it so that, and we'll look at this on the next slide, you want your project bifurcated so that these buildings are clearly the 4% and these buildings are clearly the 9%. Although I have seen some done in what we call the Swiss cheese approach, where you have the 4% and the 9% intermingled, not even just by floor, but by unit number. And I do not know how the attorney pulled that off. Luckily, I was not the accountant on that. I saw it at a panel at a conference, and I thought, I am glad I'm not working on that. You couldn't pay me enough. And so now, then the other next step is we want to make sure that we have separate contracts. And that means that we have a contract. It can be the same contractor. Not many investors are that paranoid that they're saying you can't use the same contractors between the two phases, but you definitely want to have separate contracts that are tracking what was done on a 4 and the 9, so that they're separate billing, separate invoicing, all of that, to make sure that we are keeping it as cleanly separated as possible. And we're going to talk in a second, because you're thinking, okay, separate contracts, but I'm only going to pay one sub to come in and do framing, and they're going to frame everything. So how do I track that? How do I allocate that? We'll talk about that in a second, but you want separate contracts, and you want the contractor keeping that separate as much as possible. And again, be careful with what you're spending your bonds on. You just really want to make sure that you're not spending bonds on any sort of shared or allocated costs that's going to give somebody heartburn and give them a chance to say that's not in basis. So let's use an example. You're paving the entryway to your project. Well, we're probably going to allocate that between the two phases because it benefits the both. I'd say you probably don't want to spend your bond proceeds on that, because there's going to be some concern that that's going to be allocated to the 9% and therefore taint your basis. So we're trying to avoid a basis taint. So let's take a look at this front project here. So in this case, when we did our math, we came out and we split the project. So we have 4 buildings on the right here that are 4% project, and 3 on the right that are 4%, 4 on the right that are 9%. We say, okay, Thomas, that makes sense. I can get a separate contract, and we'll be able to trace the cost of these buildings to the different partnerships. But a project is so much more than just the buildings, right? We have the leasing office. We have the common area. We have the swimming pool. We have the swing set. We have the site work and infrastructure. And all those things need to be thought about when we're doing this. And what you're going to see when we start putting these costs in these buckets, that some cost we're going to allocate across the phases. Some cost we're going to direct trace to one of the phases, and some costs are going to be kind of where all those costs go to one of the phases. Now let's talk about this later one. All the costs go to one of the phases. Well, let's talk about allocate first, because that's a little easier discussion. So we're sitting here, we're looking at, we got sewers, roads, retention pond here, things like that that are benefiting all tenants. And we can make a reasonable accounting argument that says these are going to benefit all tenants on a pari passu basis. So we're just going to take this $5 million cost here and allocate it amongst the phases based on the square footage of the units. Very reasonable. The IRS allows us to use any reasonable method to allocate costs amongst the phases. So that's fine and dandy. We can allocate those. Obviously, we want to be careful if we're spending bonds on this, how much bonds we're spending, how we're tracking that, because we can run into some issues there. But we're going to take costs like this and we're going to allocate them amongst the two phases. Now, whoops, I meant to go backwards. Where it gets a little more tricky and touchy is what we would call common area. Now, common area cost are things like your leasing office and your manager's unit, and that common area cost typically is structured so that it's owned by one of the phases and used by a different phase. You have a reciprocal easement or something there. We see this all the time in phase projects, right? So let's think phase projects for a second, build on what we know, and then come talk about this. So in our phase project, we're going to build the community room in phase one, and phase one's going to get allocated all those costs because we don't know for sure that phase two is going to be built, right, or when. And then when phase two is built, the tenants in phase two use those common areas. And we think from an IRS standpoint, we're fine because those tenants are not using it to the detriment of phase one. So typically when we look at common area costs like this, we make this interesting decision where we say, we're going to allocate these costs all to one phase and then support the fact that we have an easement with the other phase, the 4% phase or the 9% phase as it may be, depending on your project, to use these amenities. And that is fine. And that's typically how we see this done. I think that when we try and allocate it between the two projects, we run into issues because then who owns the common area, and it raises more questions. So definitely these are the issues we work through on this. And this is kind of the big picture of how we approach it. Obviously, each deal is different. Each investor is different. So we dig into this more, but again, I think we're sticking somewhat high level here on this. All right. Any questions on common area before we jump into income averaging? Or sorry, average income, as we've been corrected by our friends at the IRS. Anyways, so average income. Average income is still a fairly new provision, although 2018 seems long, long ago. This was a new provision that came into effect in 2018 that added a new minimum set aside. So in the tax credit world, previous to this, we've never been able to rent to tenants above 60% of AMI and earn credits on those. Those tenants were never tax credit eligible. They always had to be below 60% at initial occupancy and could never have rents above 60%. But this new provision added this new set aside that says, hey, you can rent up to 80% as long as the average of your designations are 60% or less. And so what does that mean? Let's take a look here, then we'll look at some examples. So the reason for this is we kind of, on a federal level, we really only had two buckets of units, a 50% or a 60% unit. Now, of course, state agencies for competitive purposes have required you to have deeper targeting in the past. But what we would see is this person who is making 80% could not qualify for basically almost any affordable housing program. So it was very hard for them to find housing. So they're very happy now that tax credits can reach up to that. But also this person down here at 20%, that from a federal level, again, state agencies often reach down to this, mainly on the 9%, not as much on the 4%. Now people making at 20% could also not only qualify for housing, but have rents that were, well, I can't think of the right term, matching their income level. And so we see that we can have these different designations from 20% to 80%, and we can take those designations and we're going to designate units in our project. And as long as those designations average 60%, we can have tenants all the way up to 80% living in our project. And we'll talk why this is important for you guys potentially if you're thinking of RAD projects or recapitalizing existing Section 8 projects or public housing projects. This can be very, very helpful. So again, we make this election on our 8609. It's irrevocable once we make it. We can make no changes. So as we've talked about, we must designate it in these buckets of 20, 30, 40, 50, 60, 70, or 80. And you don't have to use all the designations. You could have your units only at 40 and 60 and be fine. You could have 50% of your units at 40, 50% at 80 and be qualified. You would have 20% at 40, 20% at 80, 60% at 60 and be qualified, as long as they average 60. And what's interesting is at a federal level, there's no requirement that you prorate these amongst the bedroom sizes. So basically, it is truly looking at the designation of each unit. And again, it is the designation and not the actual income of the tenant. And that's important for two reasons. Number one is if you designate it a 60% unit and somebody moves in that's making 49% of area median income, but this was the only available unit to them, it's still considered a 60% unit. You haven't somehow changed your designation. The taxpayer is the one who designates the units. And two, it's based, the tenant's initial income has to be under that designation. But if their income were to rise, let's say you qualified them in a 30% unit, now 6 years later, their income is at 60%. That's great for that tenant. We're happy when our tenants are improving their lives, but that doesn't mean you lose your 30% designation. You keep it. It's just based, they have to be under the designation when they move in, and the unit retains that designation. So let's look at it. You can think about that one unit at 20% would allow you to have two units at 80% and still average 60. Or one unit at 20% would give you 4 units at 70% and still average 60. And we have a lot of different examples here. There's 100 different ways to skin the cat here to end up at this 60% or less average of your designations. And again, you can see it in a mixed income project or 100% affordable. In a mixed income project, you do have to make sure 40% of your units or more average 60% or less. So both of these projects are fine. You can also do it across buildings and have one building greater than 60% and one less than 60%, as long as you average across all the units is at 60%. Now again, for the compliance techie people on here, you'd have to make sure that you made the multiple building election in this case. And again, in Washington State, they require you to make the multiple building election when you're doing average income. If you don't make the multiple building election, then each building is treated as its own project, and therefore you could not meet the test across multiple buildings. All right, so one project, we're good. So why is this so important maybe for what's happening with you guys? So if you're trying to come out and you're doing an acquisition rehab, if the tenant was not previously tax credit, it can't be grandfathered in. It has to be able to qualify on its own now for this unit. And so we see that we run into this with RAD projects and other projects where the tenant's qualified for another program, but can't meet 60% for tax credits. So in the past, you'd either have to not take credits on that tenant or follow the Uniform Relocation Act or somehow incentivize that tenant to move out. I'm not an expert on relocation, so don't quote me on how you'd go about getting that tenant out. I think you have to send like 25 different form letters. The tenant has to certify that they have not been coerced in any way, that you have to have their next of kin. I don't know. It's this long process. But now what happens if you're doing, so we have this tenant here that qualified initially for public housing at 45% many years ago. Now you're coming out and you're trying to do a Not a re-syndication, because if they're initially tax credit qualified, they stay qualified, but you're taking some sort of other subsidized housing and turning it into tax credits. So they were originally at 45, now they're at 78%. As I said, without average income, you used to have to make the choice of how do we get rid of this tenant or how do we not take credits on this unit. But now with average income, it does allow you to reach up to higher income levels to try and qualify those tenants. So my arm disappears when I do that. Virtual backgrounds for the win. Okay, so as long as they're under 80%, you can still reach up and grab them. And so we've seen this be really, really helpful in RAD projects that we're working on. Now, it's not a panacea, right? Because you might still have tenants that are making 81% or 100%, right? So it's not going to allow you to reach up and grab everybody. But in our experience, we find that the vast majority of quote unquote over income tenants are in this 60 to 80 range. We don't see a ton that are at that 80 to 100 and above range. So this allows you to pick up many more units. And so these were really kind of some of the first average income projects that we saw get done because they just made so much sense. It was a win-win for everybody. Now, we do have compliance people on the line, I think. I know at least one. And so the thing with income averaging is there's a lot of kind of issues we have to watch out for and a lot of compliance rules that I think are probably too extreme for the purposes of this call. And we're happy to help you walk through that. But definitely average income should not be undertaken without understanding what you're getting into, because there's some more risk with compliance. There's a lot more tracking that needs to be done. And on top of that, the IRS has issued no additional guidance on how to apply some of the rules. Now, if you're doing an average income on a RAD project and your plan is to rent every vacant unit to a 50% or lower household, or 50 or 30 to qualify for your public housing funds, which is no longer public housing at that point, but you get my point, then it makes a lot of sense and a lot of those compliance issues go away. The ones that are tricky are if you are doing a mixed income project or you're doing a project where you're right at 60% and you plan to stay right at that going forward. There's a little more to think about there. So hopefully this was a big enough overview to get you kind of interested in it and see if it can help you on your RAD deals, because that can end up with more equity than you would otherwise receive. Now you can also pull some tricks with how you designate units and maybe generate some more income. But mainly we're seeing this serving two purposes. One, to grandfather in otherwise over income tenants, or two, maybe you're doing just a brand new project and you want to serve a bigger slice of the population, right? You want to reach up to those 80% who maybe are missed in your market and make sure that they have housing too. So those are the two main reasons why we see people doing it. It's not really done for a cash grab to charge 80% rents, because for every 80% unit, you have to offset it with somebody else so that you still average 60%. All right. Any questions coming in on that? Nope. All right. We are cruising along here. Plenty of time. So opportunity funds. So I did kind of give us a sneak peek at this, but why are we talking about opportunity funds? Because I wish we could do I wish you're in the audience, I could say by show of hands, who's had a project that's used opportunity funds, a tax credit project? And the show of hands would probably be maybe 1, 2 people max, maybe nobody in this group, because as we're going to talk about in a second, you really have to find that unicorn, and it is a better vehicle for some other types of housing we might be doing. But again, as of June 11th, there had been $11 billion invested. As of September 1st, there's now been $12.5 billion invested in qualified opportunity funds. So there's a lot of money out there. And in some ways, if we can figure out how to tap that, it's only going to be beneficial. To kind of put a little bit more groundwork on it before we kind of get into the numbers so you can understand big picture wise, to put it very simply, if you can find somebody who's wanting to invest in low-income housing tax credits that is a qualified opportunity fund, you should get a credit price that is somewhere over the magnitude of 3 to 6 cents higher without changing that investor's yield. And so, 3 to 6 cents is a lot of money per credit, that if you can swing that. So that's why we're going to talk about it. Again, driving home the point, we see that the majority of Opportunity Zone funds are being invested in residential real estate, followed by commercial real estate, then other types of businesses. So vast majority is looking for residential real estate. So that's where we kind of want to be looking. As a quick note, this is going to add up to more than that $11 million because, some investments are in both buckets, but we see there's a lot of money coming into residential real estate. So I'm going to go through this somewhat big picture. I gave the handout so that they can send this to you so you can read it later. But basically, when we're thinking about the benefits of qualified opportunity fund investments to the person who's making the investment, first, they get to defer the taxes they would pay on that capital gain. So they get to defer that till 2026. So as we talked about time value of money, that's important. So that's their first benefit they get. The second benefit is that if they hold it for 5 or 7 years, that they get to, and that 5 to 7 years occurs prior to 2026, they get to reduce the amount of gain that they would otherwise pay by 10% if they hold it for 5 years before 2026, or 7% or 15% if they hold it for 7 years. And again, in order to hold it for 7 years, you would have to invest it by the end of last year. So anybody investing now can only qualify for that 10%, and that 10% is on the table for investments made through December 31st, 2021. But now, the third one is the biggest benefit. The real kicker here is that if they invest in this qualified opportunity business and they hold that investment for 10 years, there is no gain when they sell their investment. So use a wild extreme example, you could invest $1,000 into a project and that investment could be worth $10 billion 10 years later, and you would recognize no gain on that $10 billion of appreciation. Now, obviously our tax credit projects are not going to appreciate $10 billion. If they do, I think we're going to have a really hard time building any new projects. But so that's basically what we're talking about in these slides here. So you have this for your notes. So if we look at this example, this person had $1 million of capital gains. Spoiler alert, he invested in a qualified opportunity fund. He meets all of these timing models that we talked about. And then after he's held it for 10 years, he sells it for his $1 million investment. He sells for $10 million, reflecting a $9 million gain. So on that $9 million gain, he reports 0 taxes. Oh, shoot. I thought I had another slide in here. I must have, oh, it's down when we talk about tax credits. And so, but basically that's big picture wise, the benefits of an opportunity zone, opportunity fund. Now, the issues, we're going to talk about the two kind of investments that might be of interest to you. One is pairing with low-income housing tax credits, and one is workforce rental housing. So the tax credit investment, it has some pros that 15-year investment required for tax credits matches up well with this 10-year hold requirement for opportunity zones. So we're going to talk about tax credit first. And so again, the timing works pretty well. It is 5 years longer for low-income housing tax credits, but not that different. The tax credit projects often end up being in opportunity zones, so that's kind of good for us going forward. But the biggest issue with making these work is, number one, to get the benefits, you have to have capital gains to invest. As we know, the majority of investors in tax credits are banks, commercial banks. And by the way that banks are set up, they really don't generate a lot of capital gains. They really only generate capital gains when they have this one exception that they can invest in low-income housing tax credit partnerships. So they recognize capital gains then, or they really only ever recognize it when they're either merging or selling off branches. Other than that, they don't have a lot of capital gains. So right now, banks are investing, depending on who you talk to, somewhere between 70 to 90% of the investment in tax credits comes from banks. So now we're pulling out our biggest investors and saying, hey, you can't really utilize opportunity zones. And that's kind of the biggest issue here. The other biggest issue is that, as we've talked about, the big kicker for opportunity funds is that there's no gain recognized on the back end when they sell it. However, if you're a not-for-profit, you're going to take this right of first refusal and you're going to take that project from them without some big cash out at the end for that investor. So they're missing out on this big kicker. However, there is a big benefit here in the sense that if they do have this large negative capital counts, now we're going to really get into the tax weeds here. If they have this large negative capital count on liquidation and they're recognizing a big gain there, which typically leads to our exit taxes. If they're opportunity fund, they have no gain there. So that is a benefit to them, but most investors look at that and say, well, you're going to pay my exit taxes anyway, so maybe that's not that big of a gain. But those are kind of the pros and cons of what we see happening here. Now, what we're seeing kind of happening generally in the market is there's two different structures we're seeing. On the left is the twinned structure, and that's where basically your LIHTC investor is the opportunity zone fund. And so basically it looks like a normal project and they're getting that benefit of having that the benefits of the opportunity fund are flowing up to that investor. So they should be able to give you a better credit price. Now there is this and I think that one makes sense to everybody. It's how we normally see it. We have the fund investing, it flows down that fund instead of just being a bank. It's a qualified opportunity fund, or instead of a syndicator or a LIHTC syndicator, it's a ozone syndicator. So you're going to see nothing different in the twin structure. The parallel structure is the one that's a little bit more interesting. And we've seen a few of these, not a ton, but this is basically where the opportunity zone investor comes in on the general partner side, and they provide either they provide equity that comes into the operating business and helps make the deal pencil. But then in that case, they're looking for a cash on cash return. And so in most of the deals that you guys are working on, not all, you have some very good deals as well, but a lot of the deals, that are public housing or projects like that, they're not generating a lot of cash. And so this model is a little bit harder to do on a project that doesn't have a lot of cash flow. If it's a deal that has a lot of cash flow, then you can potentially find it, and it's just another funding source should you not have enough sources to bridge that gap. Again, trying to talk big picture on this, so happy to talk more in the nuts and bolts offline on this with people, but want to give you enough to be dangerous. So, but why is this such an important, why is there such a big benefit to tax credit investors? Well, because if we look at that $10 million investment that tax credit investor might make, and we run through the numbers, we see, hey, originally, they would have had to pay $21 million of taxes on this, $10 million of capital gains at a 21% tax rate. But when we run it through this magic of this investment, they actually end up only recognizing $357,000 of capital gains. And so you can see that even on one where they're not hitting this home run on the back end of getting this huge appreciation, that there still can be quite a bit of benefit to them making this investment. So on top of all the LIHTC benefits that they normally get, they also received $1.8 million of savings, so almost 20% of savings on taxes here from their capital gains. And so obviously that's going to help them with their yield investment, and that's where we see this 3 to 6 cents coming into play. All right, I don't want to get too far into the weeds on that. I keep saying that a lot. That's apparently my favorite word to say on this presentation. The other one that we see kind of happening more often where opportunity funds are really kind of working in our business model is with workforce rental housing. So this is typically people from 80% to 120%. And the reason for this is that on these type of projects, you're generating a much better cash flow. So the opportunity fund investor can come in and invest in that. And on top of that, you don't have this tax rate regulation. So at the end of year 10, theoretically, you can sell it at fair market value and the investor can reap the benefit of that. So this is kind of looking at workforce housing. I don't know if any of you have done workforce housing, if it kind of falls into your mission, but if you're looking at doing that, opportunity funds can work really great. Here's a project. This is actually out of Oregon. This is a real project. It's 110 units with rents between 90 and 110% AMI. And this was a good developer that has a proven track record. And so what they did is the opportunity zone investor came in and invested 40, they put equity in of about 40%, and then they just had a regular mortgage for the rest. And this project was able to deliver basically a 6% cash on cash yield to that investor. And then in year 11, the asset will be sold. And so unfortunately, you know, at year 11, there does have to be a fair market value sell to kind of liquidate that fund, but you were able to provide workforce housing for 10 years based on this model. So something to think about. If you're interested in that, let's take it offline. All right. Now, I feel like I'm kind of course, I'm just monologuing. I'm the only one on here, but kind of pushing forward to our next topic before we get into this grab bag, and we'll have some time for questions at the end, is seller carryback notes. This has been kind of a hot topic issue as of late. And part of that is because it really has to do with acquisition rehab projects. So let's look at what we're talking about here. So on an acquisition rehab project, we have you're acquiring a project and you're rehabilitating it. And typically we're looking at one where your agency already owns the asset, and now you are going to sell it to yourself to do a new tax credit allocation. And so as we know, when you do this, the amount of the purchase price allocated to land is not eligible. The amount allocated to depreciable assets is eligible. And so you have this big incentive to, number one, allocate as much of the assets to depreciable assets as possible. And we're not going to get into this whole zero land value discussion today and those sort of things. But what we're seeing a lot is we're seeing that we're really trying every trick we can to get this appraiser to give us the highest value possible for our depreciable assets. And then how we're closing that financing gap is you're doing a big seller carryback note. And so you're saying, hey, this acquisition is $50 million. And so I'm going to do a seller take back note of, let's just be extreme here and say $50 million so we can get this project funded. And you say, that's great. Now I get eligible basis of $50 million minus land. And it doesn't really cost me anything from my equity or hard sources because I'm just doing a seller carryback note for that. And so I'm able to rehabilitate my project without really any more money out of my pocket because the seller carryback note is so large, it's making this deal balance. Hopefully we're kind of familiar with the concept because that wasn't the greatest explanation. But when we do that, we have these kind of three things that we have to worry about: the true debt test, original issuance discounts, I like how I said original issue discount issues, and 50% test issues. So let's first talk about true debt. So true debt is this concept the IRS says. They say, okay, if you're buying something and somebody's giving you a loan, there has to be an expectation that that loan is going to be paid back, or else this is just a sham transaction from the beginning. So you can inflate that purchase price, right? You could say, oh, this asset, I'm going to buy it for myself for $100 million. The IRS say, okay, $100 million, that seems high, but okay. But then they say, show me how the debt that financed that is going to be paid back. And especially if that debt is coming from a related party, they're going to say, that's a sham transaction. That property can't substantiate that purchase price. And so the true debt test, basically you have to be able to show based on reasonable expectations that there's a reasonable expectation that this debt can be repaid from proceeds from the project. And now you can include a terminal sales transaction somewhere in the future to help pay that off. But again, these have to be reasonable expectations. You can't grow your income at 10% and your expenses at 0.1% and then have a 0.01% cap rate on the back end and say, yeah, look, I can meet the true debt test. You have to be able to say that under these reasonable expectations, I can show this debt can be paid back. And sometimes we run into issues on this with our projects where we've kind of tried to get this value as high as possible. And now we look out and our only funding source is this seller take back note. We look out and we just can't reasonably support that this debt can be repaid. So if we have that, they're going to say, well, then this debt has to be reduced. And if we reduce the debt, we have to then again reduce our basis in those assets. So true debt test is something very important to keep aware of. I'm sure you've heard that before, but hopefully that helps you understand why that is. The next one, similar vein, probably something you've heard of before, but we kind of want to talk about where it came from, what it is, and why it's important. So this is original issuance discount. Basically what the IRS says is, it says, hey, somebody's going to loan you money to buy something, that lender is going to expect to earn interest on the money they loaned you. It's just part of it, right? They wouldn't give you the money for free to buy the project. And so what the IRS says, they say you have to basically assume a minimum interest rate here, or else we're going to call this a sham transaction from the beginning, and we're going to make you assume interest. So let's talk about what that means. So let's say we're buying this building for $10 million, and we say, oh, there's no interest rate for you because we like you so much, we think you're a great person, no interest rate for you. The IRS is going to say, hold on, that doesn't make any sense. So now instead of saying that this is a $10 million loan, we're going to take a discount on the original issue amount of the loan. So I love accounting because the words usually make sense, although maybe not in the right order. So we're going to make you discount that loan so that there's this imputed interest rate. So they're going to say, okay, if this is a 30-year loan and AFR is 2.5%, instead of saying that this is a $10 million loan, we're going to say, nope, this loan is discounted to $7 million. That's just a made-up math there originally. And so you're only going to get basis of $7 million. And then what happens is each year, basically, you have this interest that's imputed on it that isn't real interest you're paying anybody, but they're saying, hey, we're going to, over 10 years, as you recognize interest at AFR, when you get out to your 30-year terminal event, that yeah, this will now be worth $10 million. In our example, it'll be $7 million of note and $3 million of interest. So it's going to reduce your basis back to the beginning. And so we have to watch out for this, but you can see how the true debt test and the original issuance discount can come into play, because the higher the interest rate, the more difficult it's going to be to pay off this debt and meet the true debt test. And so you're going to want to try and push that interest rate down as low as possible, but you're going to have this floor that if you go below that, they're going to say, well, you lost anyways, because now we're going to discount this note from the beginning. So these two tests kind of have to play together with each other. And then finally, the 50% test issue is this overarching issue that comes back and says, okay, guys, that's great. You've satisfied the true debt test, you've satisfied the original issuance test, but now we have to make sure that you can meet the 50% test. And so if we're doing a seller carryback note of $50 million on acquisition, and we're only doing a $20 million rehab, well, that's $70 million of cost, but I don't see anywhere where we're going to be able to take on $35 million of bonds and still have our $50 million seller carryback note, right? So if your seller carryback note is too large, it will make it so you can't meet the 50% test. And now we've gotten creative with different attorneys and investors where we've either have that seller take back note be bond financing, so that counts, or we've had the bond financing outstanding for a while, and then the seller come out and redeem the bond financing after placed in service. So there's ways that we can structure around that, but we definitely want to make sure that you're having that conversation up front and are aware of it and know how to structure around it. So that seller carryback financing, I feel like it's been a big deal with AC rehabs lately. So I want to talk about 3 issues that are popping up there. Again, this forum, normally after this we'd go downstairs and I'd grab a Diet Coke. I got one on hand here, and we could talk about these issues as they relate to your project. So feel free to reach out to me to talk about these things, whether it's online or at the next time you see me if you're running into these issues. Okay, so now that I saw it, I had to have a drink. All right, so looking ahead, we know that this is trying times right now, but there is a bill that will hopefully help make our lives a little bit easier as we're trying to structure these projects. And now again, I feel like I need to preface this and say, this is a bill that's in the House of Representatives, and the House is controlled by Democrats. And this really is the Democrats' wish list for what they would like to do in housing. And so some of these are very ambitious, and some of these won't pass. But we're hopeful that at least a few of these will get through, and we'll talk about some of the main ones that we're looking at here. And just so you know, we haven't released this yet. You get the sneak peek, but we've been crunching numbers. We think that if all the provisions impacting low-income housing tax credits and bonds were passed, it would generate about a million new units over 10 years. So that's a lot of new units that can be generated from this. So let's talk about some of these. Again, and this is putting in context, this is different than the Affordable Housing Credit Improvement Act. It picked up a lot of the provisions that were in the Affordable Housing Credit Improvement Act that, again, is sponsored right here in Washington State. And Oregon's also a co-sponsor, so our region's very much carrying their weight on this. But I just show this to illustrate the bipartisan support that it has. So housing in general does have a lot of support on both sides of the aisle. And in fact, 36, 38 senators have signed on to it of the 100. So it shows that there is very strong support for this. But let's talk about some of the provisions. The biggest provision that people want, and if we get anything from this, this is the one that we want, and this is the 4% floor. And what that means is instead of using this floating 4% rate to calculate our credits, which is like 3.09 this month, I believe, we'd be able to, actually I think it's 3.08 this month, you'd be able to use a 4%. So we ran this at the May rate, which I think is still our same rate, although it's bounced up and down between then. You can see that if we got a 4% floor on this same project, it would increase our equity by 23% without spending any more money or doing anything differently. And that ends up closing a financing gap of $1.2 million on this project. So this 4% floor would be huge for our industry. And the other thing is it takes away variability, right? We hate variability in this industry, and having to kind of guess if we should lock that rate and what's going to happen with the rate between now and closing causes a lot of headache. So locking that at 4% would be so very welcomed. So that's number one. We anticipate that would generate 6,000 units in Washington State. Washington State typically punches above its weight on these because it uses all of its bond capped, something like 75% of its bond capped is done for residential rental housing, so for tax credits or bond deals. And so it would get a lot more units. Now, again, Washington State is cap constrained now, and all states would benefit from it. These are just the top 10 or so states. All right. I'm not going to spend a lot of time on the basis boost provisions. Just note there's a bunch of provisions out there that would make more areas eligible for these boosts. Native areas are a big one, and rural areas are a big one that would benefit our states. So, you know, Oregon has a huge increase in number of areas that would be designated due to removing these caps. And so this would be very, very beneficial to our industry because it would just result in more projects qualifying for this basis boost and more 4% projects. And in fact, there is a provision in there that would extend this discretionary boost that we have on 4% projects to 9%. I'm sorry, that we currently have on 9% projects where states can discretionary give the boost to any project that needs it. There's a provision in the HR 2 Moving Forward Act that would extend that discretionary boost to all projects. So that'd be great because then you're not worried about where you're located. You just have to show that you have a need for this boost for your project to be feasible. The other big important provision is that it would increase the private activity bond cap by 10%. And so, you know, in a state like Washington State and other states around us that are using all their bond cap, and especially if we were going to get the 4% floor and that 130% boost, it's going to make bond projects feasible in a lot more areas, that having additional bond cap would be very, very helpful. And so this increases it by 10%. And you see the difference here is we see this increase over the status quo. And that would result in about $29.2 billion in private activity cap. And then multifamily, we look at the states that use it. Not all states are like the states on the West Coast here that allocate a bunch of their bonds to multifamily housing. So we estimate that's only going to result in 11 billion more bonds for multifamily. But again, as states receive more, maybe they can allocate more of their percentage to multifamily. All right. Oh, 10 minutes early. I thought I had a couple more slides to talk about on HR2, but I think I've enjoyed the conversation. It's been very one-sided. If there's anything that you would like to talk about on any topic we've covered so far, or any other topic that's kind of top of mind right now during pandemic, happy to jump in and talk about that. I do want to come back here though, something I didn't mention that would be of interest to this audience, I think, is that all these additional funding sources that would come out of HR2, another 100 billion in affordable housing funding, 5 billion of which would be home funding. So obviously that would be beneficial to you guys. The other one is allow for accelerated credit to help address challenges caused by the COVID-19 crisis. And so that would help for these lease-up issues that we're seeing with COVID-19. This would help give additional credits in those. And I can't remember what the final language on the bill was, but the original drafts looked at just allowing you to have basically 100% for the first year, which would be incredibly helpful, but probably too generous. And I can't remember where we finally ended up on that. And then the second one is for projects that we're working on right now, is there's a provision for just 2 years, so for 20 and 2021, to reduce the 50% test down to 25%. And that's to help in projects that have cost overruns that now can't get more bonds that are at risk of failing the 50% test. It'll only be a 25% test. Unfortunately, that's only for 2 years. We ran some numbers that said, hey, if we could turn this 50% test to 25% test permanently, it would be amazing for our industry. We have a blog post on it if you're interested. But those are the two big provisions I think would be of interest to this group. If there's no questions or anything else, I'm not going to hold you and just let me babble on for 9 minutes, but I'm happy to talk about anything that might be on the top of your mind. So I'll give you about a minute to throw in any questions. Otherwise, we'll turn you away. Then you have a break till 3:30. Then you're back at 3:30 for some more, look like excellent panels. So as always, PNRC NARO does a great job with these. I'm sad that we're not there in person though. So I'm going to thank you for joining us even in these trying times, and I will turn you free. I guess I turn it back over to our host if they have anything to add.